Hi, my name is Daniel Kaat, and I am an associate professor of finance at the University of Groningen. My research areas are international finance and climate finance, and today I will present the paper Financing Nature, Investment Funds and Biodiversity Risks. And this is joint work with Alexander Rabe from the Asian Development Bank, and that is why the usual disclaimer applies, so the views are ours and do not necessarily reflect the views and policies of the ADB, the Board of Governors, or the governments that they represent. In this paper, we look at the extent to which fund managers take into account biodiversity risk in their investment decisions. And we see that only recently fund managers do take into account biodiversity risks, and recently means that this happens after the well-known Kunming Declaration that I will talk more about in a few minutes. And this reallocation of fund portfolios across countries also leads to substantial shifts in cross-border capital flows. Why is that research important? Well, as you probably all know, biodiversity losses are substantial. So based on estimates of the Financial Times in 2023, worldwide, we saw a decline in species richness between 1970 and 2020 equal to 73%. There is a lot of difference across continents. Europe and Central Asia was least affected by this decline, but still saw a decline of 35%. In Latin America and the Caribbean, the decline was even equal to 95%. We can zoom into certain anchor species, which are well known to be important for pollination, to get a very similar picture. So overall, in the last decade, we saw a decline in the insect population of 41%. One species that gets a lot of media attention, the bees, even saw a decline in 46%. And of course, the question is, if insects that are so important for pollination disappear, what are the economic implications of that? And here you see two pictures which clearly show that this decline in species richness has important costly implications for the economy. So on the left, you see a picture from the United States where pollination is done mechanically. On the right, you have a picture from the People's Republic of China, where you see that the same is done by hand. And you can well imagine that this is quite costly. This slide is only an example from the agricultural industry, which is usually seen as one of the industries most affected by the decline in biodiversity. But I could tell you a similar story for lumber, for pharmaceuticals, etc. So biodiversity losses do have significant economic costs, and therefore we would expect that they also affect financial markets. What we do is we look in the paper at how fund portfolios respond to biodiversity risk. And we look at this question using the Kunming Declaration as a natural experiment and argue that the Kunming Declaration was a Minsky moment in revealing biodiversity risks to financial markets. Let me give you a quick background of the Kunming Declaration. So it was signed by over 100 governments in October 2021 as the first part of COP15. And it set the commitment to a new ambitious global biodiversity framework, which was adopted by 190 governments a bit more than a year later in December 2022. And a lot of people argue that the Kunming Declaration is what the Paris Agreement is for climate change. It came with a lot of different targets. I don't have the time to go through all of them. I just want to give you a quick overview. So governments agreed to protect 30% of the ecosystems by 2030. There was the goal to increase the annual biodiversity finance to about $200 billion by 2030. And at least 30 of these $200 billion should flow to developing countries. Governments agreed to phase out subsidies that harm biodiversity. They implemented financial disclosures of biodiversity risk. So overall, the Kunming Declaration did not only make obvious to financial markets that biodiversity losses do carry a lot of physical risk, but also that there is an increase in transitional risk, right? So if you're a firm, an industry, or a country that contributes to a further decline in biodiversity, then you can expect tighter regulations, higher financial costs in the future. And that is why we say the Kunming Declaration should serve as a Minsky moment. On this slide, I show you a measure of biodiversity attention specific to financial markets. In particular, I am plotting the monthly Google search volume for the term biodiversity in the category finance between 2015 and 2025. And you see that until 2021, so before the Kunming Declaration, this biodiversity attention index was more or less flat. And then with the Kunming Declaration, you see a sharp increase, which then continues further on as the governments sign the Global Biodiversity Framework in 2022. So obviously, biodiversity attention increased with the Kunming Declaration. So what we do is we want to understand whether the Kunming Declaration then also had an important impact on fund managers' asset allocations. And we focus on funds because they are a very important financial market participant that can lead to very significant shifts in capital flows across countries just because they manage so large amounts of assets under management. And we construct a granular data set on funds, country allocations at a monthly frequency. So we see for a large number of funds worldwide, how do they allocate their assets under management, so across which countries. Then we conduct a difference in differences estimation around the Kunming Declaration and use as treatment a country's biodiversity risk, measured as the share of endangered species. And after establishing this key result, we look at whether country authorities do have any policy levers. So for instance, we look at whether countries that are more active in nature conservation see weaker outflows after the Kunming Declaration, even if they have a high biodiversity risk. Similarly, we also look at climate policies and macroeconomic characteristics. And finally, we analyze cross-country spillovers and regional contagion. So let me tell you what our paper finds. So first of all, we find that there is a flight to biodiversity safety. So fund managers reallocate away from very risky countries after the Kunming Declaration, which reveals that initially biodiversity risks must have been mispriced in financial markets. Let me stress here that we really find a strong asymmetry in the effects. So we see that the 25% of countries with the highest biodiversity risk lose market shares after the Kunming Declaration, and the rest of the distribution, so the other 75% of countries, they gain market shares. At the same time, we don't see that the 25% of countries with the lowest biodiversity risk benefit disproportionately more. So overall, what we see is that financial markets rather price the biodiversity risk as a downside risk, which they want to limit, rather than seeing it as an upside chance. And this has two implications in our view. The first one is that the fund industry should manage biodiversity as a downside risk, rather than introducing new products that are actually specialized on biodiversity as an upside chance. And second, these portfolio reallocations across countries that we document lead to significant cross-border capital flow shifts. And we find, based on our estimates, that the median country worldwide sees outflows of up to 0.5% of GDP when it has a high biodiversity risk. So also economically, our effects are quite significant. The second key result of our study is that funds' response to the Kunming Declaration triggers within portfolio contagion. So let me give you a simple example. If there is a fund that has 10 country positions, 9 of them have a high biodiversity risk, and then there is one country in the portfolio with a low biodiversity risk, you could expect that the 9 countries with a high biodiversity risk lose market shares, and at the same time, the country with a low biodiversity risk benefits. But this is actually not what we find. Even this country in the current portfolio that has a low biodiversity risk loses market shares. And that's what we call within portfolio contagion. And instead, we find that fund managers start entirely new positions in countries of the same geographical region that have a lower biodiversity risk. So the external margin of portfolio adjustment plays a very crucial role in our results. And finally, we show that legal actions on nature conservation shield countries from the post-Kunming capital outflows. So if you are a country that has a high biodiversity risk, but you take actions to nature conservation, So you do something against future biodiversity losses, then you're shielded from the capital outflow result that we establish in our paper. We also look at whether other policies have the same impact. So, for instance, we look at sovereign ratings. They have no impact at all. We look at whether countries with more active climate policies are also shielded, but that's not what we find either. The only shielding device that we identify in the paper is legal actions on nature conservation. So the important message is, if you are a country with a high biodiversity risk, yeah, you will lose market shares and there will be capital outflows from your economy, but you can do something against that by nature conservation. Thank you very much.